The hanging man pattern plays a significant role in trading as it signals a potential reversal from an uptrend to a downtrend. It appears at the top of an uptrend when there is a single candlestick with a small body and a long lower shadow. The small body indicates that there is a similarity between the opening and closing prices, while the long lower shadow suggests that the selling pressure was present but was not strong enough to drive the market down for the day. Traders are encouraged to practice identifying and interpreting the hanging man pattern in their trading activities. Spotting this pattern can provide valuable insights into market sentiment, indicating that the buyers are losing control and sellers may take over, potentially leading to a downward movement in the market. In conclusion, it is crucial to emphasize the importance of continuous learning and adaptability in the dynamic world of trading. Understanding technical patterns like the hanging man is just one aspect of a complex market environment. Traders should always be willing to increase their knowledge and adapt their strategies to stay ahead in the ever-changing financial markets. Candlestick patterns play a fundamental role in technical analysis, serving as a visual representation of market sentiment and potential price movements based on past and present trading data. These patterns are formed by the price movements of an asset within a specific time frame, such as a day, week, or hour. They are highly regarded for their ability to help traders and investors make informed decisions by providing insight into the continuation or reversal of market trends. Among the various candlestick formations, the inverted hammer stands out as a significant pattern that often signals a potential bullish reversal. This pattern appears at the bottom of a downtrend and is characterized by a small body at the lower end of the trading range with a long upper shadow and little or no lower shadow. The small body indicates that there was little movement from open to close during the trading period, while the long upper shadow suggests that buyers attempted to push the price up but faced resistance, causing the price to settle back near the open. The essence of the inverted hammer lies in its implication that the market is testing the ability to drive the price higher, indicating the presence of buying pressure despite the prevailing downtrend. This pattern is considered a signal that the buyers are beginning to outnumber the sellers, and if followed by a strong buying day, it may mark the start of a bullish reversal. However, traders typically wait for further confirmation before making investment decisions based on this pattern alone, as it is crucial to ensure that the newfound buying pressure is sustained and capable of reversing the prior downtrend. The inverted hammer candlestick pattern is a configuration on a chart that signals the possibility of a bullish reversal in the market. It occurs after a downtrend, indicating that the buyers are potentially gaining strength. The pattern is identified by a small body at the lower end of the trading range, with a long upper shadow that is typically at least twice the length of the body. The absence of, or a very small, lower shadow completes the pattern. This shape suggests that during the trading period, sellers pushed the price lower, but by the close, buyers were able to drive the price back up, ending near the high of the session. To describe the appearance of an inverted hammer in different trading scenarios without visuals, imagine you are looking at a chart after a period where prices have been consistently falling. Amidst this downtrend, you notice a candlestick with a small body at the bottom and a long upper shadow stretching upwards. This is the inverted hammer. Its presence, particularly in this context, hints at a change. Initially, sellers had control and pulled the price down, but buyers stepped in strongly and managed to push it back up, though not enough to end the period on a positive note. Still, this struggle between sellers and buyers, with buyers showing significant effort, suggests a momentum shift that could lead to a bullish reversal where prices begin to climb. In essence, the inverted hammer tells a story of a fight back by the buyers in a market that has been dominated by sellers. This change in dynamics can be an early sign for traders to watch for a potential upward movement in prices following the appearance of this pattern. The inverted hammer is a candlestick pattern that investors and analysts look for on trading charts to identify potential bullish reversal signals. This pattern has distinct features which include its shape, size, color, and the length of its upper wick, each playing a pivotal role in its interpretation and significance within market trends. An inverted hammer looks like an upside-down hammer, hence its name. Its main body is small, located at the lower end of the trading range. The color of the body can be either green or red. A green body indicates that the closing price was higher than the opening price during the candle's period, whereas a red body suggests the opposite. However, the color is less important than the pattern's structure and context within the trend. The most characteristic feature of the inverted hammer is its long upper wick, which is typically at least twice the length of the body. This long wick indicates that during the candle's formation, buyers managed to push the price up significantly, although the price retreated somewhat by the close. This struggle between buyers and sellers is a key indicator of potential bullish sentiment entering the market. For accurate interpretation, the position of the inverted hammer within a trend is crucial. It is primarily observed after a downtrend, signaling that the downward momentum might be waning and a potential reversal to the upside could be imminent. It suggests that despite selling pressure, buyers are starting to gain control. However, confirmation of the reversal is necessary through subsequent candlesticks showing bullish trends. To understand real instances of inverted hammers in various market conditions, one would examine historical charts during periods following significant downtrends. For example, after a sustained period of downward movement, a candlestick with a small body and a long upper wick appearing indicates the presence of an inverted hammer. Traders would then look for rising prices in the candles following the inverted hammer as a confirmation of trend reversal. This pattern is easier to spot in charts with clear downtrends followed by significant price jumps within the candle periods of the inverted hammer, indicative of changing market dynamics. In summary, the inverted hammer is recognized by its unique structure and is critical in signaling a potential bullish reversal, especially when positioned after a downtrend. Its effectiveness is heightened when followed by a confirmation of the trend reversal, making it a valuable tool for traders relying on technical analysis to guide their investment decisions. The inverted hammer is a candlestick pattern found in financial charts and is considered indicative of a potential bullish reversal. This means that it suggests a shift in market sentiment where the bearish trend may be nearing exhaustion and a bullish trend could be on the horizon. Here is a straightforward explanation of how this pattern gives insights into market sentiment and the psychology of traders, signaling a possible turning point. When the inverted hammer occurs, it features a small body at the lower end of its range, with a long upper shadow and little to no lower shadow. This shape forms because, within a trading session, prices are driven up significantly, but then they retreat to close near the session's low. This suggests that buyers attempted to push the price up, indicating growing bullish sentiment, but faced resistance as bears temporarily retained control to push the price back down. The psychology behind this pattern reveals a battle between bulls and bears. Initially, bears continue to push prices lower, but the significant upward push during the session implies that bulls are beginning to exert pressure. The key takeaway from an inverted hammer is not that bulls have taken control, but rather that they are starting to challenge the bears with increasing strength. This is a sign for investors that the bearish momentum could be weakening. For the inverted hammer to be a reliable indicator of a bullish reversal, it typically needs to be followed by a confirmation, such as a candle closing higher than the inverted hammer. This confirmation suggests that bulls are gaining strength and are more in control of the market direction. In essence, the inverted hammer is a glimmer of hope for buyers in a downtrend, suggesting that although sellers have not fully relinquished their hold, the tide may be beginning to turn as buyers start to step up their efforts. This pattern becomes a crucial signal for investors analyzing market trends, indicating a potential shift in dynamics and a valuable opportunity to anticipate a reversal in market sentiment. The inverted hammer is observed on candlestick charts, frequently occurring at the bottom of a downtrend. Its unique structure, consisting of a small body located at the lower end with a long upper shadow and almost no lower shadow, suggests a scenario where buying pressure is attempting to overcome selling pressure, indicating a potential bullish reversal. However, the confirmation of the inverted hammer as a sign of reversal or continuation depends significantly on the market context and subsequent price action. For it to act as a bullish reversal signal, the candle following the inverted hammer must close higher, confirming the buyers have overtaken sellers in the market. Without this confirmation, the pattern alone is insufficient to predict a market turnaround. Consider two scenarios. One reversal scenario. Imagine a downtrend where prices have been falling. An inverted hammer appears, indicating that despite the selling pressure, buyers managed to push the price up significantly before it closed. If the next candle closes higher than the inverted hammer's close, it serves as a confirmation of a reversal. This pattern might form in an area of support, adding to its credibility as a reversal indicator. 2. Continuation scenario. In some cases, the inverted hammer doesn't lead to a reversal. Even after its appearance, if the prices continue to decline, it reveals that the selling pressure still dominates the market. The pattern, in this context, becomes a part of the continuing downtrend, illustrating that not all attempts by the buyers to reverse the trend are successful. Visually, if we were to describe these scenarios on a chart without using images, in the reversal scenario, you would see the inverted hammer followed by a candle closing higher than its body, often with increased volume. In the continuation scenario, instead of seeing a positive follow-through, you would observe subsequent red candles, indicating that the downward trend is persisting. It's essential to analyze these patterns within the broader market context, considering factors such as volume, price trends leading up to the pattern, and the performance of subsequent candles. The inverted hammer, like all technical patterns, doesn't guarantee a market shift, but signals the potential for change, requiring confirmation to be considered a reliable indicator of market direction. To understand how additional indicators can reinforce or undermine the significance of an inverted hammer, it is essential to examine trading volume, nearby support levels, and the trend preceding the pattern. The trading volume plays a pivotal role in confirming the implications of an inverted hammer. If the inverted hammer appears with a high trading volume, this suggests strong buying interest and increases the likelihood of a bullish reversal. On the other hand, if the volume is low, the credibility of the pattern as a reversal signal is weaker. Nearby support levels also significantly influence the interpretation of an inverted hammer. When an inverted hammer forms near a critical support level, it indicates that the price is likely to bounce back from this level, strengthening the signal for a potential bullish reversal. Conversely, if the inverted hammer appears without any nearby support level, its effectiveness as a reversal signal might be less reliable. The trend preceding the inverted hammer is crucial for understanding its implications. The pattern typically carries more significance if it appears during a downtrend, suggesting exhaustion of selling pressure and a possible shift towards an uptrend. If the inverted hammer forms in an uptrend or a sideways market, its predictive value for a trend reversal diminishes. Therefore, the confirmation of an inverted hammer as a bullish reversal indicator is more robust when it is accompanied by high trading volume, occurs near significant support levels, and follows a downtrend. These factors either reinforce the pattern's significance as a bullish reversal signal or, in their absence, could undermine its reliability. The inverted hammer is recognized as a candlestick pattern that can signal a potential bullish reversal in the market. It typically appears at the bottom of a downtrend and is characterized by a small body with a long upper wick and little to no lower wick. This pattern suggests that though selling pressure initially pushed the market lower, by the end of the trading period, buyers were able to push prices back up, indicating possible changing sentiment and a forthcoming upward trend. Regarding the historical accuracy of the inverted hammer in signaling market direction changes, it has indeed shown effectiveness. However, it's crucial to understand that no pattern guarantees future market movements with absolute certainty. The reliability of an inverted hammer as a predictor for market movements can vary. It has been known to presage upward market reversals effectively in some instances when interpreted in the proper context and confirmed by subsequent price action or other indicators. Acknowledging the limitations of the pattern is essential. The inverted hammer itself may not always result in a bullish reversal. False signals are possible where the market does not move in the anticipated direction following the pattern's appearance. Therefore, it is important to corroborate the potential signal from an inverted hammer with other analysis tools. These can include technical indicators like moving averages or oscillators, volume analysis, or broader market conditions. For instance, a subsequent day closing higher than the inverted hammer's high can act as a confirmation of the reversal signal. Combining these analytical tools helps to make a more informed decision on the likelihood of a market direction change, enhancing the inverted hammer's utility as part of a comprehensive trading strategy. In conclusion, while the inverted hammer can be a useful indicator of a potential bullish reversal, it should not be used in isolation. Its effectiveness is improved when combined with other forms of analysis to validate the signal. This approach helps to mitigate risk and enhance the accuracy of predicting market movements. Integrating the inverted hammer candlestick pattern with other technical analysis tools can greatly enhance trading decision-making. This approach uses complementary indicators to confirm potential bullish reversals signaled by the inverted hammer, adding layers of validation to trading strategies. One way to combine the inverted hammer with the relative strength index, or RSI, involves looking for the inverted hammer pattern when the RSI indicates oversold conditions, typically below 30. This combination suggests that the price could be preparing to reverse upwards as selling pressure diminishes. Another useful integration involves the moving average convergence divergence, or MACD. Traders can search for the inverted hammer pattern alongside a bullish MACD crossover, where the MACD line crosses above the signal line. This crossover further confirms the potential for a bullish reversal. Lastly, incorporating Fibonacci retracements can also be beneficial. If the inverted hammer forms near a key Fibonacci support level, such as the 61.8% retracement line, this could signal a strong area of interest for buyers stepping back into the market. Now, let us consider a real-world example to illustrate how this integration can enhance trading decision-making. Imagine a scenario where a stock has been in a downtrend and forms an inverted hammer pattern. Concurrently, the RSI registers below 30, indicating oversold conditions. Additionally, the MACD shows a bullish crossover, and the inverted hammer coincides with the 61.8% Fibonacci retracement level. This confluence of indicators provides a stronger signal for a potential bullish reversal than if the inverted hammer were observed in isolation. Traders using this integrated approach might feel more confident in making a buy decision, expecting the price to rise. By adopting a multi-indicator strategy that includes the inverted hammer, traders can make more informed and confident decisions, potentially leading to better trading outcomes. One of the most significant errors traders make when interpreting the inverted hammer candlestick pattern is seeing it as a definitive sign of a bullish reversal without confirmation. The inverted hammer appears in a downtrend and represents potential reversal, but without further bullish confirmation, it does not guarantee a shift in market direction. To avoid this mistake, traders should look for additional signs of strength following the appearance of an inverted hammer, such as a gap up or a large bullish candle. Another common misinterpretation is confusing the inverted hammer with its bearish counterpart, the shooting star, which occurs in an uptrend. Both patterns have a small body and a long upper shadow, but their implications are different due to the trends in which they appear. Understanding the context in which these patterns emerge is crucial for accurate analysis. Furthermore, traders often overlook the importance of volume. An inverted hammer accompanied by high trading volume provides stronger evidence of a potential reversal because it indicates significant interest at lower price levels, suggesting that buying pressure is starting to outweigh selling pressure. To enhance pattern recognition and analytical skills, it is beneficial to practice identifying the inverted hammer within various market conditions and alongside different technical indicators. Combining candlestick patterns with other forms of analysis such as trend lines, support and resistance levels, and moving averages can offer a more comprehensive view of the market. Moreover, backtesting trading strategies using historical data can help traders understand how the inverted hammer pattern has performed in the past, aiding in the development of a nuanced trading approach. Lastly, staying patient and disciplined and waiting for confirmation before making trade decisions based on the inverted hammer pattern can significantly reduce the risk of premature entries. In the realm of trading, the inverted hammer candlestick pattern plays a pivotal role in signaling potential bullish reversals, especially after a downtrend. Strategies for leveraging the inverted hammer in setting entry and exit points revolve around keen observation and a structured response to this pattern's appearance. When an inverted hammer is spotted after a price decline, it suggests that buyers are starting to gain ground against sellers, albeit the buyers have not fully taken control. The long upper shadow indicates that buying pressure was present, but faced resistance at higher price levels. For traders, this scenario serves as a cue to prepare for a possible upward movement in prices. However, it's critical to wait for additional confirmation before acting. A common strategy involves looking for a subsequent candlestick closing above the inverted hammer's high, which provides confirmation that buyers are gaining momentum. Setting entry points involves waiting for this confirmation candle. Traders often place a buy order above the high of the confirmation candle, setting a stop loss slightly below the inverted hammer's low to manage risk. Exit points, on the other hand, could be determined by individual trading goals, resistance levels, or when there's evidence of a trend reversal back to bearish movement. Case studies where traders have effectively used the inverted hammer often highlight the importance of patience and confirmation. For instance, a trader might observe an inverted hammer at the end of a downtrend, but refrains from immediately entering a long position. They wait for the next day's trading to close above the inverted hammer's high. Upon this confirmation, the trader decides to enter the trade, setting a stop loss below the inverted hammer's low to mitigate potential losses. If the price continues to rise, the trader may then decide to exit the trade upon reaching a predetermined profit target, or if signals of a bearish reversal appear. In summary, effectively leveraging the inverted hammer for trading decisions involves a blend of cautious optimism and strategic planning. It's about recognizing the potential for a bullish reversal, confirming the momentum shift, and then executing trades with a clear understanding of entry and exit strategies to capitalize on the possible upward trend while managing risks. The inverted hammer is a candlestick pattern that signals a potential bullish reversal in the market. It is characterized by a small body at the lower end of the trading range with a long upper shadow and little or no lower shadow. This pattern suggests that despite selling pressure during the trading period, buyers were able to push the price back up, indicating the possibility of a reversal from a downtrend to an uptrend. However, confirmation in the form of a subsequent bullish candle is needed to validate this potential change in market direction. Variations of the inverted hammer and similar patterns include the shooting star and the hammer candlestick patterns, each with unique implications in trading. 1. Shooting star. This pattern is the bearish counterpart to the inverted hammer and appears at the end of an uptrend. It also has a small body at the lower end with a long upper shadow and little or no lower shadow. The difference lies in the market psychology it represents. The shooting star signals that buyers tried to continue the uptrend but were overcome by sellers pushing the price down, indicating a potential bearish reversal. 2. Hammer. The hammer candlestick is similar in shape to the inverted hammer, but occurs at the end of a downtrend. It has a small body at the upper end, with a long lower shadow and little or no upper shadow. This pattern suggests that although sellers drove the market lower, buyers were able to overcome this pressure and close the session near its opening price, pointing to a potential bullish reversal. When analyzing these patterns, traders look for certain criteria. For the inverted hammer and hammer, the long shadow should be at least twice the size of the body to be considered significant. In the case of the shooting star, the same ratio applies to its long upper shadow. To visualize these patterns on a chart, imagine a line graph that suddenly spikes upwards or downwards, but then retreats nearly to its starting point by the session's close, forming either the inverted hammer or shooting star. In the case of the hammer, the spike would be downward before the price retraces back near its opening level. These patterns, when recognized in the context of other technical analysis tools, can provide insightful trading signals. Still, traders are always advised to seek confirmation through additional indicators or a following candle that supports the reversal indication.